I see in the notes here that you at least say that nothing that has transpired in the Chinese regulatory intervention we've seen has blindsided us much, given it's been openly discussed over the last few years. If that's the case, then why have the stocks reacted the way they have, at least previously, if we could fully expect sort of what's been unfolding?
I think a lot of public market investors are sitting in New York and London and don't pay enough attention to what's going on the ground in China, don't listen to the rhetoric from regulators or even from these companies on their earnings calls when they forecast these types of developments, be it from regulators or the broader competitive landscape. And so, as we know, there's a huge psychological impact to the public markets, and ultimately people who are not on the ground here get surprised.
Yeah. You know, what I continue to hear from investors is they just want to have an understanding as to when this comes to an end, or when the playing field has sort of been set by the Chinese regulators. You know, you claim or say that this regulation is not haphazard. So when do you expect that we will actually know sort of what to expect in terms of the regulations that are being put in place?
So I don't think there's necessarily going to be an end game, a moment where we say, okay, Finn, this is done. But I think based on the frameworks that we've provided, you can anticipate which sectors are going to see sustained interference. So if you are involved in something that would be defined as a vice, be that, you know, and destabilizing society, be that creating inequity in education, or sapping the time of consumer internet users, engaging in predatory lending, those types of sectors are going to see sustained regulatory involvement, and there's not necessarily ever going to be an end game. If you're in a sector like healthcare, core technology, enterprise, those sectors were untouched by regulators, and we think will go on indefinitely with limited intervention.
Hans, I want to bring you into the conversation because there have been a variety of investors out there who have said that given all of the uncertainty out there with regard to regulation and various clampdowns, especially as it pertains to the technology sector, that China remains essentially uninvestable at this point in time until there is more clarity. Do you agree with that notion? And if there is opportunity, where is it?
Yeah, I think we actually feel more comfortable compared to a couple of months ago in terms of the risk level. I think for the past couple of months, the China government put out some of noticeable the update on the data security law, the personal information protection law, and then even recently we have seen the guideline for recommendation algorithm for internet company, and also the gaming new rule as such. So I think we have seen more and more clear direction in terms of the new regulatory environment. While there might be some uncertainty in terms of how to implement, and also in terms of the potential impact from financial perspective after these the new rule put in to the ground. So, but again, I think we actually feel like more and more investors start to figure out like whether what's the fundamental going forward and under a new regulatory environment, and I think people have more interest in terms of the investment here. And then we do see valuation-wise is also come down a lot, and I think that's much more attractive in terms of risk reward.
Ben, let me come back to you. You know, just as an example, and let me just use Tencent. I mean, they're limiting a gaming time, for example, to 3 hours a week. I think Friday, Saturday, Sunday, you get an hour, at least if you're under 18. How do you approach that name, one of the biggest out there?
Yeah, I think
now is a good buying opportunity. So we're certainly in a window of time again where you know, that type of off-continent kind of financial scrutiny is driving the stock price down. But you know, it's rare you would see a company come off this much that's seen you know, a 29% rise in profits. You know, second quarter was $6.5 billion of profit. Gaming was already coming down, and so I think the impact will be mitigated. There was already only about 13% growth. And the sectors, again, that I mentioned that are supported by regulators, supported by the official ecosystem, enterprise, they saw about a 40% year-on-year growth in their enterprise and business services portfolios. And, Tencent is a behemoth. They invest across all sectors and stages here in China and globally. Their investment portfolio reportedly yielded about $120 billion of gains over the last year and has names that would be the envy of any Silicon Valley venture capitalist. They are able to engineer really sweet deals for themselves as they work with companies and invest within the domestic market, often kind of doing a right pocket, left pocket kind of transaction where they invest in a business, get significant equity, but that investment is tied to that capital being reinvested in advertising spend on the WeChat platform, within the WeChat mini apps, et cetera. And so the net result of that is still a very healthy business that was already expecting and had a lot of this downside priced in, given the foreshadowing that management and others provided at the earnings call, and also continued competitive dynamics and threats that besiege the company daily here from the likes of ByteDance and others. So I think now is a good buying opportunity.
Okay. As we watch, there is some buying going on today in all these large cap Chinese names. Gentlemen, thanks to you both. Appreciate your time.
Shepard Smith here. Thanks for watching CNBC on YouTube.